The ledger of history is cold and unforgiving. It does not care about nostalgia. It does not care about flags. It cares about assets and liabilities. And if you look closely at the British balance sheet, you can pinpoint the exact moment the ink turned red. This isn't a story about kings and queens. It is a story about collateral. It is a story about how the wealthiest corporation on earth, the British Empire, liquidated itself to survive, and how the managers of that corporation are still trying to hide the losses. In 1913, the United Kingdom wasn't just a country, it was the central bank of the world. The City of London was the beating heart of global capital, pumping sterling into the veins of global trade like oxygen. If you were a coffee merchant in Brazil or a tea planter in India, you invoiced in pounds. Not dollars, not francs, pounds. Sterling was used for more international trade than any other currency in existence. Foreign central banks held half of their reserves in sterling. They trusted the Bank of England more than they trusted their own governments. The gold standard was effectively a sterling standard. Britain held overseas investments valued at £4 billion in 1914 prices. That is a number so large it is hard to comprehend. It dwarfed the entire gross domestic product of the nation itself. They owned the railways in Argentina. They owned the mines in South Africa. They owned the debt of the United States. They were the creditors. The rest of the world was the debtor. But power is expensive, and the most expensive luxury item a nation can buy is a world war. When the guns of August fired in 1914, the liquidation began. The bill was coming due. The First World War shook the foundations. To pay for the carnage, Britain had to borrow. The government deficit exploded. The money supply doubled in just 4 years. Prices soared. The stability of the Victorian era was shattered. But the real death blow to the empire's financial independence didn't come in the trenches of the Somme. It came in a boardroom in New York in 1941. By 1940, Britain was fighting for its life against Nazi Germany, and it was broke. The gold reserves were drained. The foreign assets, built up over centuries of trade, were being sold off to pay for bullets and destroyers. This was the era of cash and carry. The United States was not yet in the war, and the Americans were not giving away weapons for free. They demanded cash on the barrelhead. Enter the story of American Viscose. This is the deal they don't teach you in history class. It is the moment the United States knew it had Britain over a barrel. American Viscose was a jewel. It was a division of Courtaulds, the British textile giant. It was the largest supplier of rayon in the United States. It was a money-printing machine. In 1941, Britain was desperate for dollars. The US government demanded a show of good faith before they would pass the Lend-Lease Act. They wanted to see Britain bleed. They wanted the collateral. Sir Edward Peacock was sent to New York. His mission was to sell British assets to raise cash. His first target was American Viscose. The vultures were circling. The American investment banks, led by Morgan Stanley, knew he had to sell. It was a fire sale. They pushed the price down. They knew the seller was distressed. The company was worth over $100 million. But in the panic, the shares were sold to the public for a fraction of their value. The British Treasury took the dollars. Courtaulds got pounds. The sale was a signal. The transfer of wealth had begun. Britain was stripping its assets to survive, while the United States was building its industrial dominance on the back of British distress. Then came Lend-Lease. It sounded generous. The US supplied food, oil, and material for free. The arsenal of democracy. But there was a catch. There is always a catch. The equipment had to be returned or paid for later, and when the war ended in 1945, the bill arrived immediately. The United States cut off Lend-Lease without warning. Britain was facing bankruptcy, the economy was shattered, the factories were bombed, and the debts were massive. The country was running on fumes. Lord Keynes, the greatest economist of his age, went to Washington. He hoped for a grant. He hoped for gratitude for Britain's sacrifice in fighting fascism alone. He didn't get a grant. He got a loan. The Anglo-American loan of 1946 was strictly business, $3.75 billion at 2% interest. It was a lifeline, but it came with chains attached. The Americans demanded that sterling be made convertible. They wanted to break the British trade bloc. They wanted the pound to face the dollar in the open market. Keynes signed. He had no choice. He told the House of Lords that the Americans did not accept the principle of equal sacrifice. The special relationship was a debtor-creditor relationship. The loan kept the lights on, but the cost was sovereignty. Britain was now a debtor nation, living on American credit. The mortgage from hell had begun. It would take 60 years to pay it off. Britain finally cleared the debt in 2006, 6 years late, after deferring payment 6 times when the currency collapsed. Think about that. The financial cost of World War II was hanging over the British taxpayer until the era of the iPhone. That is the long tail of debt. That is the price of survival. But the real turning point wasn't just the money. It was the realization that Britain could no longer act alone. That realization came 10 years later in the burning sands of the Sinai, the Suez Crisis. This is the moment Britain stopped being a superpower and became just another European nation. It was a military failure, but it was a financial execution. Gamal Abdel Nasser nationalized the Suez Canal. It was a direct challenge to British interests. The canal was the lifeline of the empire, the route to the oil fields. Britain, France, and Israel hatched a secret plan. Israel would invade. The Europeans would intervene to separate the combatants and seize the canal. It was a classic imperial play. Militarily, it worked. The troops landed. They took the objectives. But the British cabinet forgot to check the bank balance, and they forgot to ask the President of the United States. President Eisenhower was furious. He had not been consulted. He saw the invasion as a relic of colonial imperialism, and he knew exactly how to stop it. He didn't send troops. He didn't fire a shot. He picked up the phone. He told his Treasury Secretary to target the pound sterling. The dollar was the weapon. Markets panicked. There was a run on the pound. Investors were dumping sterling. The Bank of England was bleeding reserves, trying to prop up the currency. Britain needed help. They looked to the International Monetary Fund for emergency loans. But the US blocked the request. Eisenhower said no withdrawal, no money. Then came the ultimate threat. The US Treasury threatened to sell off its own holdings of British government bonds. This would have caused a total collapse of the pound. Harold Macmillan, the Chancellor, looked into the abyss. He told the cabinet that without American support, the currency would be destroyed. The game was up. Britain surrendered. They announced a ceasefire and withdrew. It was a humiliation. The Prime Minister, Anthony Eden, resigned. The empire was shown to be a paper tiger. The lesson was brutal. You cannot run a global foreign policy on a bankrupt treasury. If you don't control your currency, you don't control your destiny. The slide continued. The 1960s were a slow decline. The sick man of Europe label began to stick. Productivity lagged. Industry failed to modernize. Then came 1976, the year Britain officially went broke. The Labour government had spent too much. Inflation was raging at over 20%. The deficit was out of control. The markets lost faith. The pound was in freefall. It dropped below $1.70, then $1.60. The Chancellor, Dennis Healey, was stopped at the airport on his way to a meeting. He had to turn back. The crisis was terminal. Britain had to go cap in hand to the IMF. It was the largest loan in the history of the fund. $3.9 billion. And the humiliation was total. A G7 nation, a victor of World War II, was being bailed out like a developing country, and the IMF demanded a pound of flesh. They demanded deep cuts in public spending. They wanted the budget deficit slashed. They wanted the money supply controlled. It was austerity imposed from Washington. The government had to cut housing. They cut defense. They cut food subsidies. The left wing of the Labour Party was in revolt. But the creditors called the shots. This paved the way for the winter of discontent. 1978. The unions fought back against pay caps. The country ground to a halt. Garbage piled up in Leicester Square. In Liverpool, the gravediggers went on strike. Bodies went unburied. They were stored in a factory. A former pie factory in Speke. Imagine that. In a modern, industrialized nation, the dead were stacked in a pie factory because the state could not pay the gravediggers enough to bury them. The social contract was broken. The post-war consensus was dead. The British people were tired of decline. They were tired of being the sick man. They voted for change. Enter Margaret Thatcher. She promised to reverse the decline. She promised to unleash the markets, and she triggered a revolution that would change the city forever. October 27, 1986. The Big Bang. The day the City of London was blown open. Fixed commissions were abolished. Electronic trading replaced the shouting in the pit. It was a shock to the system. The Old Boys Club was dismantled. Foreign banks flooded in. The Americans, the Japanese, the Germans, they bought everything. The old British merchant banks, with their long lunches and family ties, couldn't compete. They were swallowed up. The city boomed, but it wasn't really British anymore. London became the financial capital of the world again. But it was a global city, unmoored from the UK economy. A Singapore-on-Thames, floating off the coast of Europe. At the same time, the government was selling the family silver. Privatization. State-owned industries were sold off to raise cash and increase efficiency. Water, electricity, gas, trains. The infrastructure of the nation was put on the block. The theory was that private competition would lower prices and improve service. But look at who bought them. Today, the English water companies are largely owned by foreign private equity and state wealth funds. They are assets on a balance sheet. Northumbrian Water is 75% owned by C.K. Hutchison Holdings, a conglomerate based in Hong Kong. The water in the north of England is an asset on a Chinese ledger. Wessex Water is fully owned by YTL, a Malaysian corporation. The pipes under the streets of Bath and Bristol belong to Kuala Lumpur. Thames Water, the biggest of them all, is owned by a consortium. Funds from China, Abu Dhabi, and Canada, a United Nations of debt. These companies loaded up on debt. Since privatization, they have borrowed billions, not always to invest in pipes, but to pay dividends to shareholders overseas. Thames Water alone issued £3.1 billion in green bonds, while sewage poured into the rivers. The infrastructure is crumbling, but the payouts continued for years. The regulators call it flow trimming, a polite way of saying they divert sewage into rivers to save money at the treatment works. It is a scam. It's the same story in energy. We don't build our own nuclear power stations anymore. We pay the French and the Chinese to do it for us. Hinkley Point C, the massive new nuclear plant in Somerset, it is being built by EDF, the French state energy company. Think about the irony. The French government owns the company that keeps the lights on in Britain. When EDF has financial trouble, the French state steps in. But who steps in for the British consumer? We are a client state in our own energy market. We are dependent on interconnectors. We import 16% of our electricity. This dependence is not theoretical. It is a weapon. During the Jersey fishing dispute in 2021, the French government made a threat. They threatened to cut off the underwater cables that supply electricity to Jersey, a NATO ally threatening to turn off the lights over a fishing quota. The British government called it sinister. But it was a wake-up call. If you don't generate your own power, you are at the mercy of those who do. We rely on imported gas. We rely on imported technology. We rely on imported capital. The industrial base that built the Spitfire and the steam engine is gone. And now we are seeing the final phase of this hollow-out. The London Stock Exchange, once the envy of the world, is shrinking. The capital is fleeing. The numbers don't lie. In 2024, 88 companies delisted from the London Stock Exchange. Only 18 new ones joined. That is a death spiral. The valuations are too low. Investors in London are risk-averse. They want dividends, not growth. So the innovators, the tech giants, are going to New York. Look at ARM Holdings, the crown jewel of British tech. Their chip designs are in almost every smartphone on the planet. They were born in Cambridge. But when it came time to list, they chose NASDAQ. They chose New York. SoftBank, the owner, knew they would get a higher valuation across the Atlantic. It was a blow to British prestige. The Prime Minister lobbied, the city lobbied. But the market spoke. London couldn't match the liquidity and the appetite of Wall Street. Then came Klarna, the buy now pay later giant. They looked at London, they looked at New York, they chose New York. Another unicorn lost. Klarna was valued at $45 billion in 2021. Even after a valuation drop, they still saw the US as the only viable market for their IPO. London wasn't even close. Even the stalwarts are restless. Shell, the biggest company in the FTSE, has threatened to leave. The CEO said the company is undervalued in London compared to Exxon or Chevron. If Shell leaves, it's game over. It would be a signal that London is no longer a Tier 1 financial center. It would be a regional market for legacy industries. Unilever has had similar thoughts. These are global companies. They have no loyalty to a postcode. They go where the capital is. And the capital is leaving London. Why? Because the British pension funds stopped investing in Britain. They put their money into bonds and global equities. The domestic capital base has dried up. We are seeing a vicious cycle. Lower liquidity leads to lower valuations. Lower valuations lead to delistings. Delistings lead to lower liquidity. The hedge funds smell blood. Marshall Wace, Bridgewater, they are building short positions against British companies. They are betting on the decline. Marshall Wace has massive short positions against Whitbread, the owner of Premier Inn. They are betting against the British consumer. Bridgewater, the world's biggest hedge fund, has been shorting UK stocks. They see the weakness. They see the inflation. They see the lack of growth. Meanwhile, the economy is stuck. Productivity growth has been flat since 2008. We are working harder, but we are not producing more. That is the productivity trap. The budget is a mess. The new government talks about a £22 billion black hole in the public finances, a recurring deficit that needs to be plugged. This isn't a one-off. This is structural. It reflects unfunded commitments. Asylum support. Ukraine aid. Public sector pay rises of 5.5%. The Chancellor, Rachel Reeves, says the gap is real. She says she has to make difficult decisions. That is code for tax rises or spending cuts. It feels like 1976 on repeat. The numbers are bigger, but the problem is the same. We are living beyond our means. The state is too big for the economy that supports it. Brexit was supposed to fix this. It was supposed to unleash global Britain. We would sign trade deals with the world. We would revive the Anglosphere. We signed a deal with Australia. It was heralded as historic. The government touted it as a major victory for post-Brexit freedom. But look at the fine print. The government's own impact assessment shows the deal will add just 0.08% to GDP. By 2035, 0.08%. That is a rounding error. It doesn't even begin to cover the loss of trade with the European Union. We swapped a market of 500 million for a distant dream. Goods exports to the EU are down. Red tape is up. Small businesses have stopped exporting because it's just too difficult. The friction is real. The Kanzuk idea, an alliance with Canada, Australia, and New Zealand, is a romantic fantasy. The geography doesn't work. The trade volumes aren't there. The combined GDP of the Kanzuk nations is $6 trillion. That sounds like a lot, but compared to the US at 20 trillion or China at 14 trillion, it is a second-tier bloc. So where does that leave us? A service economy that relies on the city, while the city is losing its crown. An energy system owned by foreigners. A tech sector that sells out. Is there a way back? Or is this the slow, comfortable slide into irrelevance? There are sparks of hope. The UK is still a leader in artificial intelligence. We have 144 unicorns, companies valued at over $1 billion. We are third in the world for tech, behind only the US and China. London is still the tech capital of Europe. It has more unicorns than Germany and France combined. The ecosystem is vibrant. Companies like Wave are pioneering autonomous driving. They are using deep learning to teach cars to drive like humans. It is cutting-edge stuff. Quantexa is leading in decision intelligence. They are using AI to stop financial crime. They are a British success story. But the pattern repeats. We invent it, then we sell it. DeepMind was bought by Google. SwiftKey by Microsoft. We are an incubator for American giants. Wave just raised over $1 billion, but the lead investor was SoftBank, the same SoftBank that took Arm to New York. To recover, Britain needs to stop acting like a hedge fund and start acting like a nation. It needs to invest in its own assets. It needs to build, not just finance. The £22 billion hole is a warning. The 88 delistings are a warning. The sewage in the rivers is a warning. The infrastructure of the country is creaking. We went from the master of the world to a debtor nation. From the workshop of the world to a warehouse for imported goods. From the ruler of the waves to a small island with a big bank. The question is no longer can we rule the world? The question is can we pay our bills? And right now, the answer is far from certain. We are at a crossroads. One path leads to a high-growth, high-tech future where we retain our best companies and rebuild our sovereignty. The other path leads to a museum economy, a place where tourists come to see the palaces of a dead empire, while the real business is done in New York, Shanghai, and Singapore. History is watching. The ledger is open, and the balance is yet to be struck. The fall was long. The recovery will be harder. I want to leave you with one question. It's a question that every investor, every voter, and every citizen needs to ask themselves right now. If a British company invents the next technology that changes the world, will it be listed in London, or will it be sold to the highest bidder in California? Let me know your answer in the comments below. And if you want to understand the forces shaping your money and your world, please subscribe.